A junior trader joins a prestigious firm. He's assigned to shadow the top performer, a trader with $100 million annual P&L, years of consistent returns. For 6 months, the junior watches everything, every entry, every exit, every position size adjustment, every risk decision. The senior trader hides nothing. He explains his process openly. He walks through the logic in real time. He answers every question. The junior takes detailed notes. He builds spreadsheets. He models the exact same setups. He copies the rules precisely. And every month, he loses money. Same strategies, same markets, same information, opposite results. The junior assumes he's missing something, a hidden variable, a secret the senior is not sharing. He's not missing anything. The senior's edge was never in the rules. It was in the execution shaped by years of pattern recognition. It was in the position sizing calibrated to his specific drawdown tolerance. It was in knowing when to override and when to trust the process. The edge belonged to the senior. It could not be transferred. The question is, how do you truly develop one that belongs only to you? This is edge development for systematic trading. This will help you understand why copying fails, why decay is inevitable, and how to build something sustainable from personal strengths rather than borrowed ideas. My name is Ashim Nandi. I am a system architect with 10 years of experience between running an IT company and full-time trading. In both fields, I learned the sustainable advantage never comes from what you know. It comes from how uniquely you apply it. Here are the chapters that will help you understand this concept better. First, the nature of edge. You will understand the 6 types of edge and which ones align with different strengths. Second, why edges die. You will see the evidence for alpha decay and understand the adaptive market forces that make it inevitable. Third, developing personal edge. You will have a 5-stage framework for building something that cannot be copied because it is built around you. Think in odds. Act with discipline. Chapter 1. The nature of edge. The senior trader had something that rules could not capture. Let us name what that something actually is. A trading edge is a consistent, repeatable advantage that produces positive expected value over many trades. Not one trade, not 10 trades, over hundreds of trades. Here is the important distinction. Edge is not the same as strategy. Edge is the core inefficiency or advantage being exploited. Strategy is the complete system built around that inefficiency. A trader can have a perfectly designed strategy with clear rules, proper position sizing, and risk management. But if the underlying edge does not exist, the strategy will slowly bleed capital. The math guarantees it. Expected value from video 3 connects directly here. The formula: win percentage times average win minus loss percentage times average loss. When that number is positive, an edge exists. When it is 0 or negative, there is no edge. The math does not negotiate. Consider a system with a 40% win rate and a 3-to-1 reward to risk ratio. The expectancy is positive. An edge exists. Now consider a system with an 80% win rate but a 1-to-4 reward to risk ratio. The expectancy is 0. No edge, despite winning most trades. Trading edges come in different forms. Informational edge means processing data others have not yet observed. Alternative data, satellite imagery, web traffic patterns, credit card transaction flows, not insider information. Legal, systematic information gathering. Analytical edge means a superior method of interpreting the same information everyone sees, combining technical, fundamental, and quantitative framework in ways others do not. Behavioral edge means maintaining discipline when pressure is the highest, executing the process when emotions push traders to deviate. This is the capacity to be different when being different is uncomfortable. Structural edge comes from market access, lower transaction costs, or the ability to operate where competition is thinner. Execution edge comes from speed, automation, and precision. Organizational edge comes from team composition and aligned incentives. Renaissance Technologies provides the clearest example. The Medallion Fund averaged 66% gross annual returns over 3 decades. During the 2008 financial crisis, it returned 98%. In 2020, during COVID, it returned 76%. Jim Simons described it this way: patterns of price movement are not random. However, they are close enough to random that getting some edge out of it is not easy and not so obvious. Edge is not a single insight. It is a process of finding, measuring, and maintaining advantage over time. Understanding these various types of edges allows a trader to identify which one aligns with the personal strength rather than chasing edges that do not fit. But here's the harder truth: even a real edge does not last forever. Chapter 2: Why Edges Die. In 1970s, Eugene Fama proposed the efficient market hypothesis. The theory states that prices reflect all available information. If true, no trading edge should persist. For decades, this created a tension. Academic theory said consistent outperformance was impossible. Practitioners like Renaissance, Bridgewater, and Two Sigma kept outperforming. Andrew Lowe at MIT offered a resolution. The adaptive market hypothesis treats markets not as physics, but as biology. Markets are populated by intelligent, but participants who learn from mistakes adapt to environments and compete for survival. Natural selection determines which strategies persist and which die. The key insight: efficiency is not binary. It exists on a spectrum, shifting as the number of competitors changes, as information flows faster, as technology evolves. Markets can be rational and irrational depending on conditions. Opportunities appear and disappear as populations adapt. The evidence is striking. In 2016, McLean and Pontiff published a landmark study in the Journal of Finance. They analyzed 97 trading strategies originally published in academic journals. Returns declined 26% when tested on out-of-sample data. That suggests some of the original results came from data mining or overfitting. But after publication, returns declined an additional 32%. Traders read the research, they deployed the strategies, and the edges eroded further. Total post-publication decay 58%. The mechanisms are well documented. Crowding occurs when too many participants exploit the same signal simultaneously. First movers capture the most profit. Late arrivals find diminishing returns. Momentum strategies shows positive excess returns for roughly 10 months, then turn negative as crowding overwhelms them. Market adaptation causes self-correction. As strategies become widely known, the inefficiencies they exploit shrink towards zero. At equilibrium, alpha disappears. The technological arms race compresses every time frame. Signals that once persisted for days now decay in hours. Speed becomes the differentiator. Strategy lifespan data tells the story clearly. High-frequency strategies last days to weeks. Momentum algorithms survives 3 to 6 months. Swing and position systems hold for 6 to 18 months. Macro and fundamental approaches may persist 1 to 3 years. The decay is accelerating. Information travels faster. Computational power grows. Transaction costs fall. Barriers to entry shrink every year. This also explains why copying someone else's edge fails. Knowing that edges decay means any sustainable approach must include continuous adaptation. The edge is never static. It evolves or it dies. So if edges decay and copying fails, the only path forward is developing something unique. Chapter 3: Developing Personal Edge. The starting point is self-assessment. Strategy design introduced 4 personal variables. Those same variables now determine which type of edge aligns with a trader's strengths. Risk tolerance is not what a trader thinks they can endure. It is what they actually endure when drawdown happens. The difference between theoretical comfort and real-world emotional response is where most traders discover their true limits. Time availability determines the appropriate time frame. Scalping requires constant attention. Day trading requires active hours. Swing trading requires periodic check-ins. Position trading requires patience measured in weeks and months. Analytical style matters. Systematic processors thrive with rules-based approaches. Intuitive thinkers thrive with discretionary pattern recognition. Both can develop genuine edge, but in fundamentally different ways. Research suggests introverts tend toward systematic approaches more effectively. Their analytical, discipline, and detailed-oriented traits fit the requirements of rule-based trading. Extroverts may find the isolation and repetitive discipline of systematic trading difficult, but there is no single personality that guarantees success. The key is alignment between personality and approach. The development process follows 5 stages. Stage 1: Exploration. Study multiple approaches. Identify what resonates and what fits naturally. Stage 2 is specialization. Focus on a specific edge type and build deep expertise in that area. Stage 3: Quantification. This is where intuition becomes data. The edge ratio provides one measurement: maximum favorable excursion divided by maximum adverse excursion, both normalized by average true range. An E ratio above 1 means trades move more in the intended direction than against it. An E ratio below 1 means the opposite. An E ratio of 1.6 means trades travel 0.6 additional volatility units in favor. Expectancy provides another lens: win percentage times average win minus loss percentage times average loss. Positive expectancy confirms that edge exists in the data. But sample size matters enormously. 20 trades showing a 65% win rate carries no statistical significance. The p-value exceeds 0.2. It could easily be luck. 200 trades showing a 65% win rate carries strong statistical significance. The p-value drops below 0.01. The law of large numbers from video 3 applies directly to edge validation. Stage 4 is personalization. adjusting the approach to personal strengths, available resources, and lifestyle constraints. Stage 5 is continuous adaptation, monitoring performance for signs of decay, refining the approach, evolving with the market. These 5 stages are not linear, they cycle. Exploration leads to specialization, which leads to quantification. And when the data shows decay, the cycle returns to exploration again. If everyone knows about it, it is not an edge. The edge must come from something unique to the person executing the system. Personal strengths, personal analytical combinations, personal evaluation of the approach over time. A developed personal edge, quantified and continuously adapted, transforms a trading system from a set of rules into a genuine competitive advantage. The junior trader never became the senior trader. He became something else, his own trader. He stopped copying the senior with $100 million P&L and started measuring his own patterns. He found his risk tolerance was lower. His optimal time frame was longer. His analytical strength was in combining fundamental context with technical triggers. None of that matched the senior's approach. All of it matched him. 3 years later, his edge was real, quantified, positive expectancy across 200 trades, an E ratio above 1.4. Not the senior's numbers, his own. The senior trader noticed. He said something the junior never forgot. You finally stopped trying to trade like me. That is when you started trading. In our first Principles of Trading series, we are building the complete foundation. Risk defines survival. Position sizing defines growth. Expected value determines whether a bet is worth taking. Volatility shapes adaptation. Liquidity permits execution. Structure reads current state. Regimes identify environment. Technical analysis interprets price. Fundamental analysis interprets value. Probability and statistics give us the language of uncertainty. Strategy design built the vehicle. Edge development gave it fuel. In our next episode, we are going to explore one of the most uncomfortable and unexplored subject in trading: crisis management. What happens when a trader faces destruction? How does a trader navigate through chaos? And how can a trader make a comeback from the ruins? This is facing your own inner demon. This is crisis management for trading. Think in odds. Act with discipline. See you in the next one.